Some of the more important investment implications for the coming environment can be concern about valuation in an environment of greater uncertainty. In many elements of markets, we think that there is some evidence of overvaluation. It's an environment akin to summer of 2016, when we were in a bond market environment of significant negative nominal interest rates in most government bond markets. That's increasing currently, and therefore one should be cautious and selective about how they position from a government bond perspective. We are focusing much more on relative value rather than absolute value, focusing much less on directional risk, but thinking about best bottom-up security selection, focusing on areas where one can be overweight or underweight or even long or short, both in corporate bond markets and government bond markets, and trying to find good yield, high-quality opportunities in a more uncertain environment. So in emphasizing flexibility in a world where investors have to increasingly deal with disruption, there's probably a few reasons that we'd want to focus on flexibility. One is maintaining liquidity. Two would be asking ourselves a simple question: are we getting paid for the risks that we're taking in the bond market? And how, in a more uncertain environment, can we produce positive results? Not just benchmark-oriented, but truly positive returns. So liquidity, focusing on getting paid for the risk that one is taking, thinking about repositioning through times of volatility. It's this concept of grinding, pausing, accelerating. Grind out carry, grind out yield as markets are doing okay. Pause, observe during periods of dislocation, disruption, and volatility, and then capitalize on those moments to reposition portfolios. One other note to be made in terms of the secular outlook and dealing with disruption is the critical importance of forward-looking risk management. Portfolio managers and risk managers always work in concert, but this is the type of environment of increasing uncertainty, increasing volatility, increasing disruption, where forward-looking risk management in thinking about scenario analysis and stress testing is critically important to managing the downside risk and giving you that chance to grind, pause, and accelerate. In this environment of growing uncertainty and a period where investors increasingly have to deal with disruption, it's PIMCO's strong view that active management and strategies that are actively managed will benefit clients.